just wanted to say welcome, everyone. My name is Valdete Berisha, and I lead FinDev Gateway. If you're new to our community, I'd just like you to remember a couple of things about FinDev. We are a platform of CGAP housed within the World Bank, and our work focuses on financial inclusion. So if you'd like to learn more about our work, you can visit our websites, findevgateway.org and cgap.org. The second important thing to remember about FinDev is that our role is to enable the financial inclusion community to engage in a constructive dialogue so that we can learn from each other and challenge ourselves to do our best as a community and ensure that our work has impact. Before we begin, I just wanted to go over some logistics because this is, we have a large group joining today, so it's important just to keep a few things in mind. First, you should know that this webinar is being recorded and we will share the recording after the event. We encourage you to ask questions throughout the event, so use the chat box to post your questions. We will keep the microphones muted so that we can have a smooth conversation with the panelists. But please do put in your affiliation in the chat box when you ask a question. It just helps provide context. My colleagues Alexander and Abby will also we will all work together to go over the comments and questions and see how we can best address them with a panelist. But I just would like to ask everybody to please keep your questions short, relevant, and to the point so that we can address as many of them from as many of you as possible. So that will also allow everybody a chance to participate. And also just keep in mind that we want to preserve bandwidth. So your webcams, we ask that you keep your webcams off. We just have enabled them for the speakers. And last but not least, my colleague Sarah Edwards here is here to support. If you have any technical issues, feel free to reach out. Hopefully we'll be able to troubleshoot them, but I hope we don't have an issue. So, but she is there to help with that. So with that, I would like to introduce our moderator, Alexander Sortirio, who is a colleague from CGAP. Alexander is a senior financial sector specialist at CGAP. He works on a range of issues related to financial inclusion, including micro and small enterprise finance and the links between financial services, livelihoods, and access to basic services. So with that, I'm going to pass it over to you, Alexander, to introduce the topic and the speakers and kick off the conversation. Thanks.
Thank you, Valdete, and thank you to everybody for joining today's webinar. I think we have a really exciting discussion lined up for you. And as Valdete said, my name is Alexander Sotiriou, and I have the pleasure of acting as a moderator for the webinar. I think this topic of reassessing microfinance as a development tool is an exciting one. Of course, the financial inclusion and microfinance communities are constantly evolving. This isn't a sector that stays still for very long. But there has been a renewed interest in reconsidering what the role of microfinance is in improving people's lives. And I think these three papers on the screen here exemplify the trend. And the first paper, written primarily by Greta Bull from the Gates Foundation, includes a foreword from Melinda French Gates. And the other two are part of a working paper series from New York University's Financial Access Initiative, which is, with the first one being authored by Tim Ogden and Jonathan Murdoch, and the second by Joyce Klein and Tim Ogden. So these three papers are excellent, and they really serve as the inspiration for today's webinar. I would encourage all of you to read them. We'll add links to these papers in the chat, so hopefully you can refer to them at some other point if you haven't looked at them already. But the goal of today's webinar is not to present these papers in detail. So if we could go to the next slide, please. So the goal for today is to extract some of the key themes from these papers and just have an open-ended conversation with them about them with the panelists and with all of you in the audience today. So we're going to start with a discussion among the panelists that's going to be structured around these three high-level questions. So the first one being, why does access to credit and other forms of capital matter for women? What role should subsidies play in supporting access to finance? And what would it take in practice to get microfinance to live up to its potential? So as the panelists are discussing these issues, and as Valdete mentioned, please type your questions or comments that you might have into the chat. And we're going to try to set aside at least 20 minutes towards the end of the hour to go over these. So next slide, please. So we're joined for the discussion today by 4 highly distinguished panelists who are no strangers to the financial inclusion communities. They probably don't require an introduction, and you should already have the brief bios and the webinar invitation. So in the interest of time, I'll just share the very briefest of intros to them, just the names and organizations at this point. So we have Greta Bull from the Gates Foundation, who was the main author for the first paper that served as the inspiration for today's webinar. And then we have Tim Ogden from NYU's Financial Access Initiative, who is a co-author to the other 2 papers that inspired the webinar. And we're going to start the conversation with some opening remarks from Greta and from Tim based on their papers. But we really want to spend the majority of the time today discussing how these ideas are being or should be manifested in practice. So I'm delighted to also have on the webinar today Andre Simone from Finca International and Bridget Doherty from Brock International. So that's all I have for the introductions to the webinar. So without further ado, let's get things kicked off. So just one moment. Greta, I'd like to start with you. The paper that you wrote called for re-examining the role of credit and more broadly of capital in supporting women's economic empowerment. I think it was an impressive piece and very broad ranging, covering a number of topics that are important to this webinar in some way, shape, or form, and we'll hopefully get to a lot of those topics over the course of the webinar. But I did want to kick off the conversation today with just 2 or 3 high-level issues that it'd be great to get your thoughts on. So the first is, why is access to capital important for women's economic empowerment? And why should we think beyond SME finance if we want to promote women's economic empowerment? Those 2 are very related. And then the last one, is what's been your perception of how the thinking in international development has evolved over the past 5 years or so regarding the potential impact of microcredit? So I know it's a lot, but if you could just kick us off with some high-level thoughts to frame the discussion for today. Over to you, Greta.
Sure.
Thank you.
Thanks, Alexander. 3 tiny questions to cover in a very short period of time. But thanks to the CGAP team for organizing this session and inviting me to participate. I'm excited about this discussion. Let me first start by talking a little bit about what we mean by capital, because I think this is an important distinction to make. We very intentionally used the word capital in the white paper because we wanted to talk about money going out to women. That money could take the form of a cash transfer, it could be an asset transfer, it could be a capitalization grant to a VSLA, or it could take the form of credit. And the way we think about capital is across a spectrum. It either goes out in one direction or it goes out and comes back at different price points. And I think we need to really reassess how we think about capital, because it's all about getting money to people, right? And all of these modes of delivering capital have different levels of efficiency and different levels of impact, and they do different things, right? And we argue that we need to start thinking about capital along a spectrum and better match the supply of capital to the needs of the households we're targeting with that capital. So why is capital important for women's economic empowerment? Well, a lot of the time, poor households just don't have enough money. So how do we get money into their hands in the most effective way? And I think we have to recognize that money can play multiple functions, right? So it can help play a resilience function, operating like a safety net. It can play a stability function, which is something like helping smooth uneven incoming and outgoing cash flow. It can play a growth function, so investing in enterprises with the purpose of growing them. And we think all of these types of capital are really important, but that we need to get a lot smarter about how we target. Not least because money's in really scarce supply. So if we could give cash transfers to everybody, we know they have impact and that's a good thing, but countries are facing serious fiscal constraints. We don't have that much money. And so we need to think about ways that we can get the most bang for our buck for poverty alleviation purposes possible. And, to your point, targeting those resources to women is a good bet for at least three reasons I can think of. So firstly, we know from the evidence base that when women control household resources, they're much more likely to invest in their children and their families. There are good outcomes in everything from health to education and family well-being when we get resources to women. But secondly, women are important economic actors in their own right. By getting resources to women and empowering them to make effective use of those resources, we can contribute to accelerating economic growth. So if 75% of your population's out of the labor force, as is the case in parts of South Asia, you're going to have a natural cap at some point on the extent to which your economy can grow. Finally, and I sort of wonder why I have to say this, but having your own money by itself is empowering and it gives you agency and control over your life. And women deserve to be able to make their own choices about their lives. It shouldn't require saying, but sometimes it feels like it does. But then, why we need to think about SME finance, it's pretty simple. It's where the women are. Women are not so much in the SME segment. They're in the nano, micro, and small segment, and even before that. So in the paper, just to illustrate this, we use statistics from Uganda to demonstrate this. So according to the IFC, Uganda has 1.1 million MSMEs, of which 94% are microenterprises, 4% are small enterprises, and 2% are medium-sized enterprises. And if we break that down, that means we have a grand total of 66,000 small and medium-sized enterprises in Uganda, some proportion of which will be run by women. But no matter how fast those enterprises grow, and it's likely that they won't grow that fast, it's unlikely that they're going to create lots more jobs for Ugandans. So if we could focus on creating stability and even modest growth for the more than 1 million microenterprises in Uganda, we might be able to create some reliable employment, which is actually something we should all be focused on. But more importantly, if you actually do the math and look at the total adult population of Uganda, it's roughly 23 million people. Most Ugandans aren't running or employed by MSMEs. 1 million microenterprises in Uganda. They're living in the smallholder economy, which is where about 80% of the population is. And so I always hear people talk about, how a central challenge in Africa is that we have too many microenterprises. I think we have too few. We have too many people eking out an existence on subscale plots of farmland in places like Uganda. So I think we need to really reassess how we think about MSME, and we need to think about how we reassess how women fit into that segment. And we need to widen it to include the ultra poor and subsistence entrepreneurs to better understand how people earn an income. And we have to recognize that women are overrepresented in those segments, the ultra poor, subsistence, and micro entrepreneur segments. So if you want to focus on women's economic empowerment, you have to be focused on those segments. In terms of how international development communities evolved in the last 5 years, I mean, it's kind of hard to break down, but I sort of think of it in three distinct phases, right? So the first was the euphoria phase. We found a silver bullet that's going to solve poverty and it's going to pay for itself. There was a Nobel Prize, there was a year of microcredit, there were all the things, right? The second was a sort of disappointment phase. The impact evidence tells us this doesn't work. Dang, let's focus on payments and fintech. That looks like a silver bullet and it can get to scale. In Africa even. I don't think either of those phases was right, actually. This is complicated space. And so I think the third phase, which is where we are now, is a more realistic phase that seems to acknowledge that there aren't any silver bullets for poverty alleviation, but that credit somehow matters and has a positive impact narrative if you look at it in a more nuanced way. And then we don't actually have a lot of great options for delivering it to people in ways that they can meaningfully use while still being fully commercial. And nowhere is this more true than in sub-Saharan Africa. And those who have read the paper will know that that is the focus of our paper. And I think it's in part because in places like Latin America, Eastern Europe, South Asia, they benefited from a lot of donor support when microfinance was fashionable, right? Unfortunately, we started building microfinance in Africa around the same time that MFIs were commercializing and the donor money was looking to other places. We'd proven it could be commercially viable in those other parts of the world, so it would be commercially viable in Africa, right? But we never put some of the supports in place that were routine in our work in other parts of the world. We just thought it would be commercial and in the poorest and most fragmented region in the world, and it would work. And, we were wrong. It hasn't worked. It hasn't got to the same kind of scale we've seen in other places. And so what we now have in Africa is a patchwork of different kinds of institutions offering financial services, from microfinance institutions to banks to MNOs to fintechs, and they all face commercial constraints that make it really difficult to serve this segment well. And we speak in the paper about the economics of these constraints, and often, we have a conversation about the impact evidence off here in a corner, like it's distinct from the business models required to deliver those impacts. And we really need to think about those two things together. And none of this should really surprise us. This is a problem we have in the US too, and Tim will talk about this, I'm sure, at some point in his comments. But, we have CDFIs and government-supported credit programs here for the same reason. It's because it's really hard to reach low-income and marginalized populations responsibly with products that serve their needs. It's just hard. If you'll indulge me for one other minute, I want to speak for just a moment about 3 misconceptions I think we need to address if we are going to advance the cause of microfinance. The first, and I've alluded to this previously, is that it should be a fully commercial industry, and Tim will dig into this a lot more than I can. I think what we've learned in recent years is that if you are serving low-income populations and trying to do it responsibly, there are trade-offs between impact and traditional measures of commercial success. And purely commercial models, especially when done at scale, will either limit how far down market you can go, as is the case with a lot of banks, or it'll result in fast churn digital consumer loans, which is the case in a lot of the fintech world. The economics make productive credit for low-income populations incredibly difficult to deliver on commercial terms, unless you got big before you had to deliver those commercial returns. And, Bridget's here from BRAC. I think that is, an example in Bangladesh that's been hard to replicate in other places. I think the way
at the risk of cutting off, apologies, but if I just in the interest of time, if you wouldn't mind, maybe just another 30-40 seconds. You said you had 3 points, but just want to make sure we're able to get to everybody.
So,
thank you.
Bottom line on subsidy, and Tim will talk about this more. I think we need to think about what the delivery value chain is and place our subsidy where there is no commercial value proposition. And we can talk about that more later. It's about smart subsidies, right? Second point is our goal. We seem to frame everything around enterprise growth. That's what most of the RCTs anchor on. But what if an enterprise doesn't want to grow, which actually the financial diaries tells us most don't, but wants to provide a stable income for a family and the people they employ? So I think we need to think as well a little bit differently about what our goal is. I think it should be about smoothing cash flows, helping people to stay working rather than dismissing and rehiring, and continuously having people as occasional labor. And the third is that there are better or worse ways of delivering financial services to poor people, and that these are distinct categories that somehow shouldn't connect. VSLAs and SHGs, bearing in mind those supply side constraints, are perfectly sensible ways of delivering simple credit products to new to credit customers in a very efficient way. And it's actually a good way to onboard people to how to use credit products. Similarly, fintech delivered digital consumer loans play an important resilience function, right? And think about how we all use credit cards here in the US when we're short on cash. And by the way, that's how we all, develop credit histories for ourselves so that we could get things like mortgages later on, right? So I guess the question I would pose is, if we have customers who have successfully paid off multiple consumer loans on time, why are they not being offered better terms and conditions, given that they've proven that they're good credit risks? And that's where I think we're fundamentally failing as a collective. And I think donor funding should really be focused on how do we build those ecosystems that help us deliver not only more, but better credit to women's enterprise. I'll stop there.
Thank you, Greta. Excellent introduction, wide-ranging, as I said in the paper. A lot of great content there. Definitely encourage everyone to check out the paper itself. I want to pick up on the last note you mentioned, Greta, about donor funding. I think that's a good transition, turning now maybe to Tim. The 2 papers that I highlighted at the outset they both talk about the importance of donor funding and subsidy and microcredit, that there's some misconceptions there. And again, highly encourage everybody to read the full papers themselves. But I want to ask you 2 questions related to this. First is, what should be the role of subsidies in providing access to credit, especially if we want to target women borrowers? And second, there are a range of priorities tugging at donors, including things from addressing climate change and healthcare issues globally, and limited donor and government funding to go around. So why should any of that go to subsidizing credit markets? Over to you, Tim.
Well, thanks, Alexander, for giving me the easy questions on how we allocate global resources to the poor. But just in summary, and the links to the papers specifically are in the chat for anybody who wants those. But first of all, as Greta referenced, a lot of the idea of microfinance as an industry was built on some things that turned out to be not quite so true about the ability of microfinance to be fully self-sustaining and the benefit of eliminating subsidies. And so the idea there was that because subsidy is in short supply, if you make subsidy-dependent organizations, that limits their scale. And what we need to do is increase access to as many people as possible. And that's part of what Greta just said. The point is, how do we increase access to capital, whether it's credit or not, but how do we increase access to capital to more people? That's a really valuable goal. That was the right goal. How do we get more people access to capital? And the idea was that subsidy would in fact limit that. And that was based on the history of a lot of agricultural credit. They provided heavily subsidized credit. This is in the 60s and 70s. And whenever you misprice things in markets, you create lots of incentives for people to make sure the loan goes to their buddy or their friend or their connection. And the microfinance movement evolved in this place where we were all carrying around these lessons of the misallocation of subsidy from the history of development in the 60s, 70s, and early 80s. So out of that came this idea that we need to eliminate subsidy. Eliminating subsidy will make more capital available, will increase availability of capital. And it turns out that that was really not right for a number of reasons. One is it failed to take into account the structure of markets in lending. And there's a concept here, the economics of information, and that the cost of capital has not just to do with the cost to the provider, but the cost of enforcement and repayment. And when you're talking about trying to extend capital to people that you know very little about, where you don't have credible ways of enforcing repayment, right? Banks, lenders have to radically raise their prices of capital to account for the people who will strategically default. And that, in fact, then pushes many of the people that we're trying to reach out of the market. The cost of capital is too high. And so subsidy can distort markets, but it can, in fact, the lack of subsidy can also just eliminate access for a huge number of people, particularly in the kinds of markets that we talk about. One of the reasons we know that's true, by the way, is that if you go back and look very carefully at the financial data, which my colleague Jonathan Morduck did with Bob Cull and others, and identify that subsidy in the industry, even when this idea that the goal is no subsidy and fully commercial sustainable microfinance is what we're aiming for, subsidy never really went away. And in fact, it disproportionately went to larger organizations who were serving less poor and less female borrowers. So the subsidy, less than 40% of microfinance institutions made it to this space of less subsidy. And the ones who made it to the less subsidy were the ones who were doing the least outreach to the people that we were originally trying to reach. So the details and all of that analysis is in the What Win-Win Lost paper. But the other thing I want to point to here as we talk about this, and a point made in the second paper, is the United States throughout the history of the microfinance movement has been viewed as this, look what happens if you don't have microfinance. And that's, in fact, entirely backwards. The US financial system is the outcome of an environment rich with microfinance, without this focus on how do we ensure fair, equitable access to people that the markets are not all that interested in serving. And so, just the quick story, if anybody's read David Brugman's book, they know Jonathan Swift did some microfinance in Ireland in the 1600s, But another part of the story is Benjamin Franklin created 2 microfinance banks in the United States in the 1700s. The reason the city of Boston has a municipal water system is the returns from a microfinance institution that Benjamin Franklin set up in Boston. But at the same time, I tell that story because that institution was controversial because it abandoned lending to poor apprentices to make middle-class housing loans. So they made a huge amount of money and used it to fund the water system. So mission drift, upscale away from the people that this has been baked in. And that's what we've seen over and over again in the United States at efforts. And that when we look at how the need to get capital to the kinds of folks that Greta is talking about, it still requires subsidy in the United States. It still requires subsidy despite the fact we have the best technology infrastructure in the world. It still requires subsidy despite the fact that we have the most efficient commercial banking sector in the world. It still requires subsidy despite the fact that we've got the best, most experienced regulators and consumer protection groups in the world. And so, recognizing that even in this environment, subsidy is necessary, I think should tell us a lot about how we should be thinking about subsidy. Now, then the follow-on of that is, though, of course, it's possible to do subsidy badly. We have lots of experience with bad subsidy, but it is possible to do subsidy really well. Now, to your last question, we could spend the next 6 hours just laying out the parameters of an answer to a question of why finance versus other development priorities. But, the bottom line is, as we talk about, subsidy is necessary, but subsidy isn't very big in this space. And it has the ability to multiply. There's a difference between subsidy that crowds out capital and subsidy that crowds in capital. And so, what we've seen from the evidence of access to capital is that access to capital can make very large differences in the lives of the excluded, and that the amount of subsidy necessary to extend capital to those audiences is often not very large. And I think that is the primary case for prioritizing access to finance. And then the second is, of course, that access to finance, I would argue, more than almost anything else, provides immediate optionality, control to the people who get it, right? They get to choose what they want to do, where most of the other interventions are about somebody else deciding for people what their situation is going to be like. Access to capital prioritizes the individual making choices about their own lives. What do they want? And I think that's a powerful part of the argument.
Thank you, Tim. Very powerful argument indeed. Just a quick note on this point that you made about commercially viable institutions. The ones that really grew to scale are not necessarily the ones that are reaching women per se, or the most excluded segments. We actually just did a bit of research at CGAP looking at data from MFR that showed precisely that. Those institutions that tend to reach more women tend to be NGOs, so that nonprofits. They tend to be smaller in scale, and they tend to struggle more financially. So there's some hard data supporting what you're saying there, and maybe I'll link to that. But just thought I would mention that as well. And I want to turn now to away from the theory that's in the papers and something that's maybe a bit closer to practice. So here, Andre and Bridget would love to hear from both of you, since Brock and Finca are really at the front lines of dealing with these struggles and having to operationalize and put into practice sustainable institutions in some really challenging operating environments. So I really want to spend the rest of the webinar on some of these practical details of what does this mean? What does the financial inclusion community need to do? But to kick us off, I wonder if I could ask both of you the same or similar question about what your experience has been in this trend of commercializing the microfinance industry, and what are some of the trade-offs that you've seen, and are we currently getting the balance right? So again, really high level questions. Would love to get your thoughts to kick us off, and then we can have a more open-ended conversation with each other and with the audience. So Andre, if I could maybe go to you first on the question. Over to you.
Thank you. So yes, and I think that Tim laid it out so well in the paper comparing the US lessons for microfinance. There is a trade-off that has to be made in order to maintain commercial performance. The reality is that the customers that we serve, and keep in mind that 80% of Finca's clients are self-employed. They are self-employed out of necessity. And our customers are not standard clients. Most traditional financial institutions achieve high levels of efficiency by standardizing, and certainly microfinance has done a lot of the same. But the needs of our customers are very different. So first, they have lack of ID, they have no formal credit history, they may not even have registered their businesses. They have challenges with literacy, with numeracy, with connectivity. They have challenges with accessibility. And then there are a host of other issues. And so by definition, they're more expensive to serve than a traditional client. And microfinance has done a lot to try and standardize operations so that we could improve performance and improve efficiency. But Finca still loses money on loans lower than $1,000 across our network. We are internally subsidizing those clients that are taking smaller loans. And some would say that's actually a very high threshold, but we've done a lot to reduce the operational expenses. And I think that the side impact of that standardization is that across most of the microfinance sector, what you see is that the product offering is still pretty rigid and limited. It's not aligned with customer needs. And so there's a big challenge for all of us to take a page from some of the more innovative fintech companies and really leverage data analytics to deliver customization, which our customers need, and product innovation. But a lot of those fintech companies, as Greta said in the beginning, they don't have the same motivations that social impact-oriented institutions do. And so we have to really step up our game in that area. A lot of institutions still rely very heavily on social guarantees and collateral for risk management, whereas the banking sector, uses scoring and risk-based pricing, and we don't. We have highly manual processes that dominate most of our operations still. The fact is that I think a lot of microfinance institutions have really fallen behind on implementing technology, and that's impacting the speed, it's impacting the cost to the customer, and it's impacting the flexibility of what we offer. But it's expensive and challenging to implement technology well. And a lot of microfinance institutions are too small to be able to afford that expense in isolation. So I think that, I'll just close by saying there is a deep understanding that the user cost, as Tim was saying, we're forced to charge higher rates to compensate for losses, but that means that we're leaving people out. And if we really want to achieve higher impact, we've got to lower that cost to that end customer. And that's something that all of us across the sector, I think, really need to challenge each other to try and achieve.
And Alexander, if I can just, because Andre brought it up, and this is a big hobby horse of mine, is, as damaging as the idea that microfinance shouldn't need any subsidy was the idea that we can fix these problems with technology is I think one of the central problems right now. Yes, technology can lower marginal costs of lending, but the costs of generating, developing, maintaining, securing, protecting, evolving IT systems is very, very large. And so, the idea that what's one of the points in the the paper about lessons from the United States is that technology itself is not going to save us. The total cost of ownership for technology, particularly for the organizations that reach the poorest, is as much of a problem as the problem of operations. It's not really going to save that much money.
Very good point, Tim.
Can I just,
I was going to mention a related point too from your paper, Tim, that as you bring costs down, that also makes higher income customers more attractive. It makes the operating model more efficient, period. And then the question is, how do we get companies to keep focusing on the excluded when they're more efficient and can be even more profitable going up market, which I thought was an excellent point. And I know, Andre, you had a response too, but I do want to bring Bridget into the conversation as well. So could I ask if it's just a 30-second intervention? Otherwise, I'll go over to Bridget.
It is literally just 30 seconds, but I want to pile on to Tim's point about technology not being a panacea and say that there is an additional risk, which is we are talking about trying to drive behavior change that relies on building relationships of trust. And most of the excluded, marginalized populations that we are trying to serve don't have access to that technology themselves. And so we have to maintain that human connection for a host of reasons. Thank you.
Very important point. Thank you, Andre. And I know I've seen a lot of questions coming into the chat. So Bridget, after you speak, I'm going to ask Valdete to come back in and maybe share one or two of the questions that we can have discussion with the panelists on. But at this point, there's been a lot of interesting points at the theory level and then in practice. Andre, Bridget would love to get your thoughts as, again, with an organization that has struggling with these issues on the ground, trying to make institutions work and scale. What has been your experience? Over to you, Bridget.
Thanks, and thanks for having me. Yeah, I think the idea of commercialization isn't a trend. It's something we've been living in. I had a chance to catch up with a colleague who retired from the industry about 10 years ago. And I was telling him about the issues that we're facing, the challenges we're facing. And he sighed and laughed and said, oh, these are the issues we were facing 10 years ago. And what are the challenges? I mean, Greta spoke to them, Andre spoke to them. We have not fit for purpose regulation, increasing regulation, the high cost of capital, not to mention all of the things that are totally out of a practitioner's control: pandemics, environmental events, political coups, economic collapse, inflation, hyperinflation. And 9 out of 10 times, the practitioner is bearing the risk for these incidents that aren't within our control. There are trade-offs, and there are trade-offs to the size in which we are able to grow. But I think BRAC has chosen to really be laser focused on mission. We really are prioritizing that impact bottom line. That is the objective of our work. And our financial viability enables that impact objective. You know, our clients are mostly, majority of them living on less than $550 a day, mostly in rural areas. And about 90% of our portfolio, the loans are less than $300 on average. So very, very small. And BRAC has found success, I think, in part because we've been able to have low-cost structures. But it's becoming increasingly challenged to maintain low-cost structures. And what margins we did have, and we do have, we're really used to fund growth in our existing markets into new markets. And that's becoming challenging. It's becoming challenging to think more about the investments we have to make in terms of innovation. So what role can subsidy really play in thinking about innovations, and not just from a technology perspective, but in building efficiencies, in reaching the last mile, in reaching the women we're intending to serve. So I think, Greta, too, your paper really well captures what those challenges are, and it is a good time now for us to really think creatively about how we can address those challenges into the next phase of the evolution, so that we're not really speaking about these same challenges 10 years from now.
Thank you, Bridget. Valdete, love to bring you back into the conversation here. I know you've been monitoring the chat and we've covered a range of topics. Is there any question or set of questions, we could turn back to the panelists in general or specific that is seems to really resonate or come up a few times. Over to you, Valdete.
Yeah, I think a lot of the questions are also around the conversation on various topics, especially on the business model question. I think this, idea that subsidy, different business models work better for different segments of the microfinance sector. So there's a comment. There's actually a question. Has anyone attempted to use the Copenhagen Consensus Center to compare impact and costs of microfinance, SACCOs, and VSLAs? So I guess it's a question about the trade-offs between impact and costs. What I learned so far is that VSLA costs $10 subsidy per member, while microfinance roughly costs $100 subsidy per client. So a related comment or question is, how do we provide serious research and support to 45,000 savings and credit cooperatives and 1.3 million agri-cooperatives for reaching out to 2 billion people? So I think that's a related question, but the second question then that also came in by email a couple of times has to do with regulation. So it says, based on my experience, a significant challenge in regulating the microfinance sector is when the sector's performance is solely measured by monetary metrics. So we are neglecting the social impact aspect. So how can we get this aspect? How can we pay more attention to this aspect of the social impact? Especially because central banks are always concerned about financial stability.
Thanks, Valdete. So it sounds like one set of issues around the relative efficiency of supporting different types of capital interventions from VSLAs to microfinance institutions that are more formal, and the other on really figuring out from a regulatory and other perspective how to get maintain a focus on the impact that we want to achieve. So I see Greta with a hand up. So Greta, do you want to kick us off? And then Andre as well. Let's keep it conversational. If we can keep our comments 30 seconds or so, and then that way we can really be more dynamic and have a conversation with the group. But Greta, let's start with you.
Yeah, I think this point about VSLAs and SACCOs is a really important one. And I think we have to recognize, though, that there are big distinctions between the services offered by microfinance institutions and VSLAs and SACCOs. So we work with the National Rural Livelihoods Mission in India, which provides financing through 100 million women through an SHG platform, which is not dissimilar from VSLAs we're seeing. And to the point that I made earlier about Uganda, 1.1 million potential micro enterprises to serve. Well, 1.7 million Ugandans sit in VSLAs, right? So they're getting a service that they can't get somewhere else. And so I think we overlook this at our peril. The problem is the instrument that you get from a VSLA is limited, right? It's a great way of managing risk. And I think some of the things the World Bank is doing with capitalization grants to women's groups is really interesting because it gets money into the community, but it also circulates, right? But like if you're in a VSLA, you put your money in, you wait your turn, and you get your loan for some period of time. If you're running a business, that's not a really great solution for you. The problem is you don't have great solutions in the private space either. And I think that's where we need to get to, where we can find ways of moving women who are able to use and need better loans to move into the more commercial microfinance space. But right now there's a huge gap between those two systems. And I think this is a place we should be focusing. But I'm a big fan of SACCOs. I'm a big fan of VSLAs. We just need to recognize that what they deliver has limitations.
Very interesting point, Greta. And I recall back to the illustration from your paper of the ladder that we want to think about. I think that makes a lot of sense. And then how do you move people up that ladder? But Andre, over to you. And then it seems like Tim has a hand up as well.
Yeah. Well, first, just to reinforce what Greta said, I think we really have to stop thinking about it as either or. In this space, we really are not competing against each other. We're trying to build together in order to get to that place. But I actually wanted to come back to the point of technology, and specifically to this point of measuring impact. And I think that there any number of funders, investors, lenders across our space will say that institutions are too slow in being able to produce data that they can use to evaluate not just creditworthiness, but also to target the impact that they want to achieve. And we are still across multiple systems compiling all of this information. And I would say Finca is actually relatively tech forward in some instances. We have to do better, one, at understanding what the customer needs are. And that really, we can get a lot of leverage out of small data points that can help to point us in the right direction. Two, in actually reporting on the impact that we're achieving. And that, yes, requires research, but also there are a lot of outcome indicators that we can use more effectively and that we can share with our funders. And then, of course, providing the financial information. And I think that there is a really important role for technology to play in that. We're not talking about using necessarily super sophisticated algorithms, but really some basic blocking and tackling that can help improve efficiency, but also connect the dots for funders and practitioners like us.
Thank you, Andre. Tim, you wanted to come in on these two questions as well? I saw a hand up.
Yeah, just quickly, I do want to commend to everybody the Gates Women's Empowerment paper and reframing this as, how do we get access to capital? And not, it isn't about credit, it's about capital. And there are different ways of delivering capital. And I think the paper does a really good job of pointing out, like, it depends on the situation, what the goals of the people are, what is the appropriate kind of capital or mechanism for getting that capital. And for anybody who's curious about that, I think that's a really great resource, the way it's discussed in that paper. But the other thing I wanted to come in, there's a comment like, haven't we been having this conversation for 20 years? How do we stop having this same conversation? And I want to offer some grace to everybody here in the sense of, we've been having this conversation for 400 years. We've only been having the conversation in global microfinance for 10 or 15 years. But this is, in fact, the same conversation, right? Credit unions were created in the first place because of the exact same issue that we're seeing and we're talking about now. And, again, drawing on the US experience, right? We now have something called a community development credit union, which would have been, for the people who created the credit union movement, like, why are you using two extra words to say the same thing? But the reality is, no, actually, because we don't continually keep this conversation, we have to keep this conversation, or what happens is we drift away and we end up having to reinvent again. What is it, the kind of institution that we need to reach to the people who aren't being reached? It doesn't happen automatically. The subsidy is permanent. The focus on reaching the unreached is permanent. And the only way you do that is continuing to have these conversations, not pretending like we fixed these issues, because they're permanent.
Thank you, Tim. And your points, I think, resonate with a few of the things that Bridget said in her comments about talking with a colleague who said we're having these same conversations before, and as you say, it's a evergreen type of a question. But Bridget, I wonder, as Brock is a large, multifaceted institution that does have relationships with donors as well as commercial funders, how do you react to these issues and the relative efficiency of using donor capital appropriately to move progress in the right direction? What have been some of your highlights or findings that you might want to bring to the conversation?
Thanks. I am following the conversation in the chat, and it's really, really great. But I think Retta mentioned, when we started in Bangladesh 50 years ago, after a war of independence, Bangladesh is, of course, unique with its one language, relatively homogenous culture, density. And you can compare that to Uganda that has 40-some languages, but it had a supportive NGO environment, and it had lots and lots of donor capital and lots donor capital for 20 plus years, and it didn't become self-sustaining into the 90s. We compare that to where we are in Africa, in Uganda, Tanzania. We also benefited in the early 2000s from large sums of donor capital from the Gates Foundation, from the MasterCard Foundation, which allowed us to grow and scale quickly, but we also were able to start there as an NGO. But we can't just have an NGO anymore because of regulation. We've had to separate those entities. In some cases, you have to have an approval for every single branch that you open, and there are just limits to the size and the scale that you can achieve in some ways for regulation. And I think we can work on that, continue to work on that, getting our regulators into the field with us to really meet our clients and understanding the challenges that we face. But that donor capital, even in East Africa, and we had it in West Africa as well, allowed us to be sustainable institutions and reach a sizable portion of the population to weather all of the factors and the crises that we're facing now. But something will have to give, because in our case, we aren't passing the costs on to the customer. So I do think there is a role for donors to come back into this space, to not only help us grow in these and really reach scale in these existing markets. We have 350,000 clients in Tanzania, but we're barely scratching the surface. So yeah, there's a whole host of things on the changing investor landscape and trying to find like-minded investors. But you do sometimes feel like there's a square peg that you're trying to fit into a round hole on some of this. But for those of you who want to do impact measurement, I would just say listen to your clients. There are other tools also available now through 60 decibels where you can really listen to your clients and make operational tweaks to just see, are you reaching the people you want to be reaching? Do they appreciate your service? And are you contributing to their financial resilience, to their ability to save, to their household welfare? So I think there are options where you don't have to invest in the technology first. There are some incremental things that you can do. But let me pause there. Thanks, Alex.
Thank you, Bridget. And I see Greta with a hand up, but I see also that we're getting close to the top of the hour. I wonder, Valdete, are there any other last final questions before we get to the top of the hour? There's clearly a lot to discuss, so I might invite some of the panelists who are available and audience members to go beyond, but maybe we can sneak one more question in before we do a quick sort of round of final comments. Valdete?
Yeah, maybe a related question on regulation. There's a question that asks, there's a renewed push in many countries to regulate VSLAs, saving groups. One example is Uganda. What's your view on the benefits of regulation? To me, it seems an impossible task in many cases, and one that risks undermining the strength of informality. So maybe we can try to tackle that one first.
Greta, over to you. You have a hand up.
Yeah, I think this is a great question. I would give you an opposite example, which is India, which has a massive self-help group ecosystem that has on top of it what are called cluster level federations that are basically small credit unions, and they're not regulated. At some point, they get big enough that you sort of wonder whether some kind of self-regulation needs to be in the mix. I do think there's a risk that regulation kind of kills things, but at the same time, there's money involved, and so some degree of structure around the industry may make sense. But I think it's about being smart and matching the regulation to what the function of the entity is doing, right? And actually, one thing in Peru that's really interesting is the way they think about regulation is that they regulate activities, not institutions, and they make that distinction so that they, if any entity is providing microfinance, they regulate it as such, right? And so they have a very nimble regulatory framework. Alexander, can I just jump in and say one thing? I think BRAC deserves a lot of credit actually for exemplifying this ladder that we talk about, right? So not only does BRAC serve 90+% women consistently across their operations, they also have a really great story around using different instruments to bring people along, right? So between 50 and 65% of the graduates of ultra poor graduation programming in Bangladesh go on to take loans from BRAC Microfinance. That is unbelievable. I mean, these are people who are destitute. They get them on their feet, and then they're able to take a loan and engage in productive activity. And, I think BRAC has been really good at resisting the siren call of complete commercialization. It makes it difficult for, I used to work with the IFC. The IFC had a lot of trouble with investing in BRAC, but BRAC has also proven that it can deliver impact. And I think it's a good case study in that trade-off. And we talk about it a lot in our paper. So just a call out to BRAC on that.
Thanks, Greta. And I see now that we are very close to the top of the hour. So what we'll do now, I know some of the panelists need to leave at the top of the hour shortly thereafter. I imagine many of the audience members, guests need to as well, but there's so much to discuss. I would invite anybody who's able to stay longer to stay on. But what we'll do is maybe just last round here of sort of closing remarks. Any final questions? If I could ask each panelist to keep their remarks to maybe about a minute so we can get to close close to the top of the hour. And I know Bridget, you have another engagement, so maybe we'll start with you, and you just received some high praise from Greta there, so turn to you, and then maybe we'll go to Andre, Tim, and Greta for the last word before we continue again for those who are able to stay on. So Bridget, over to you.
Actually, Alexander, can I just quickly say, we just posted a poll, a survey. Please, it will stay open, so just let us know if you'd like to have a follow-up conversation on this topic, and just provide some feedback in the meantime before you leave. Thanks.
Thanks, Valdete. Bridget, over to you now.
Thanks. I don't know if I should follow what Greta said about UBG and BRAC. I think maybe I should just end it there, but I think I'm eager about this next phase. I have hope for this next phase. We know that microfinance isn't a silver bullet, but we know that it is one intervention in a toolkit, in the development toolkit, where we're able to really help women realize their potential. And if you ever have a chance to meet a microfinance client, these women are vibrant, they have dreams, they have ambitions, and we have the opportunity to get the capital into their hands for them to realize those ambitions. So excited about this next phase. And I think I'm hopeful for the future that we won't be having the same conversation in 10 years. Thanks.
Thank you, Bridget. Andre, over to you.
Yeah, I share Bridget's hope. I think that we have an enormous opportunity to really work on optimizing some of the tools that we know work, but also to make some additional investments in innovation. And I think that in that rush to commercialization, we have underinvested in innovation, particularly around what the customers themselves need and want from institutions like ours. And I think that we have an enormous opportunity to do good work with some technology, but also leveraging that connection that we have with our customers. Thank you.
Thanks, Andre. Tim?
I think based on the results of the poll, I'll just go ahead and say we are going to host the follow-up webinar as a 5 Live. That's a webinar series that we connected FAI. And so we'll work together with FinDev Gateway to make sure everybody who is here gets an invitation to that as we get it scheduled. And thank you for the input on what questions we should follow up on, but agree that this is a really fascinating conversation. Sort of two closing, maybe three closing, very quick closing things that I would say. One of the things that I get deeply concerned about in this conversation about subsidy is where we see there have been a lot of experiments to find ways of better structuring credit contracts to achieve the goals that we wanted. And almost universally, none of those new innovative products last beyond the test. They don't last beyond the test because donors don't recognize that innovation and rolling out part of the business model is standardization. So if you want a new and innovative product, you've got to be able to underwrite the costs to organizations like BRAC and FINCA to change their operating model and retrain all of their staff and develop all the IT behind that thing. And that's where we keep running into these problems. And I think that's a really important part of this conversation. Second is, regulation really does matter. We know, based on history of looking at the evolution of financial services, that light touch regulations are possible and they do matter. Lack of regulation is a bad idea. Heavy touch, expensive regulation is also a bad idea. But it's also a continually evolving idea. There's a book about finance in New York State that looks at, over the course of 100 years, there were 160 laws passed and credit regulations. More than half of them were adjustments to earlier laws to adjust for the fact that they got it wrong the first time. It's hard, and it does need to evolve because the world evolves. And so I'm excited how many people are here that are committed to continuing to learn, continuing to evolve, continuing to stay in this conversation and figure out how we do it better.
Thank you, Tim. Greta, any last words before we go to the extended version of the webinar?
Yeah, very quickly, I'd like to respond to something that's in the chat, saying that Michael de Groot finds this discussion very focused on old school MFIs since the 90s, no new challenging initiatives on how to reach the poor. Actually, there's been a lot of new stuff going on about what reaches the poor. We've had fintech, we've had MNOs get into this space, we have banks trying to serve these populations, we have banks trying to connect with chamas. This is hard. And I think what we have to think about is how we take all the learning. We need all those things, by the way. It's not that fintech is better and microfinance sucks. It's like we need all those things and we need impact first, right? And so how do we think about using our subsidy as donors to support the regulatory frameworks that we need? How do we think about investors coming in ways that really do put impact first? I hear a lot of talk about impact first. I don't see a lot of walking that talk, right? So how do funders come into this space, and how do operators up their game? I mean, I think both Bridget and Andre have spoken to this. We have the same crappy cookie cutter products out there right now, and we need to get a lot better about how we do it so that people can actually progress, that people can grow into better products, right? And I think Brack and Finca, others are focused on this. I see banks trying to come into this space. I see fintechs trying to operate in this space. We need all the things, but we need to have much nimbler, smarter regulatory framework, subsidy, funding. Like, we just need to understand that this is A, important, and B, hard, especially when you're trying to reach women. And so we need to be a lot more clever about how we get money, capital out to low-income people in meaningful ways. And that includes VSLAs, all the things, right? So I think we have to think about this as an integrated ecosystem and place our subsidy where we think it will have the impact it needs and let the commercial stuff do what it can do on its own. That's it for me.
Thank you, Greta. And I'd like to take a moment here just to thank everybody in the audience for staying this long. Those of you who are able to stay, please stick with us. But those of you who are not, we'll say goodbye now and thank you. And also to the panelists, Bridget, Andre, Tim, Greta. This has been a fabulous discussion. We can see from the survey results that there's great interest in these topics. We hope to continue the conversation another day, and for those of you who are able to stay on, to continue the conversation for a few more minutes here with us. And if you're not able to, we'll say goodbye and thank you now. So we'll take a brief pause before we continue on. So just thank you very much to everybody.
And thanks to Bridget specifically.
Yeah, thank you for having me. And I look forward to hearing the outcome of the rest of the conversation. Thanks.
Great. So I think we're now in the bonus material side of the webinar. Let's keep it fully open-ended, unless Valdete, if you see any burning questions there. I will just wait for anybody to chime in with any issues that you'd like to go into greater depth on, or explore conversationally for the next 10 or so minutes.
Actually, there's a couple of questions that I wanted to just pose that I got from the chat, and then let the panelists address them if they wish to, or you can also read the comments and respond to some of them. So one has to do with impact. For those organizations that are interested in measuring impact, where should they invest? Personnel, technology? And a related question about impact is it a fallacy that the RCTs are the gold standard for impact measurement? So that's on impact. And the other one that I thought maybe it has been already touched on different points in the conversation, but it's about how do we, so microfinance institutions are increasingly becoming like commercial banks. That's a comment. How do we get them to stay focused on the social, on impact? And what is the role of MFI boards and governance structures to ensure that they stay focused on the underserved targeted markets? So I think those are, and then please feel free to just look at the other questions and chime in.
I would just on that, Valda, speaking of conversations we've been having for a very long time. Yes, randomized controlled trials are better at definitively establishing causality and impact. It is not the only methodology that it is useful, but it is the best for clearly understanding causal impact. I don't find it a very useful conversation to keep having that. We shouldn't be talking about RCTs as the only way of measuring impact, nor should we pretend that a randomized trial is not the best way of establishing causality. That being said, on some of these other questions, there is a set of learning on what makes a smart subsidy. And when we talk about what is the role of boards and making sure, and donors and making sure, yes, what's measured, what is that phrase, Greta? What's measured is managed. What you manage what's measured, whatever that phrase.
You can't manage
is.
what you don't measure, or something like that.
That too, right? So that being said, I think when we talk about smart subsidy, one thing I would say here is there's a really interesting version of smart subsidy that we see being championed by Give Directly and Mackenzie Scott, which is find good organizations, don't raise the cost of your subsidy by putting in lots of measurement. Trust that organizations that have been spending a long time being client-focused and caring are gonna do it. They're not likely to change just because you give them some money. But second, for many organizations, right, there are incentives, and making sure that you're asking questions about who are you serving and how are those people doing. And there are light touch ways of doing that, of looking at a pathway. Where are we trying to get from point A to point B? What are some intermediate steps between there? And we can, in a light touch way, measure to see, are people seem to be on that path that we've identified in more expensive ways of evaluation that helps point the way without being a full-on super expensive impact evaluation all the time.
Excellent points on smart subsidy. Andre, you had a hand up, and please, there's only a few of us here, so I think we can just chime in, talk as you think make sense. But over to you, Andre.
Yeah, well, no, I want to reinforce what Tim said. I think that very few organizations can afford the RCT level research. And it is not just time consuming, but also really, I think the customers themselves may not necessarily want to participate in that level of research. But we need to be less shy about using self-reported data. It can provide you with a really quick snapshot of how your customer feels about where they are, which I think, again, provides a lot of insight to organizations that are looking to adapt the model that they're offering. And so we do a lot of pulse surveys with our customers. You can call them over the phone and collect that information. You can ask them when they are working with a credit officer to provide that information. And I think the sort of the corollary of that is that you don't need all the information. We are obsessed by data. I am obsessed by data as well. But I think that we can collect less information from smaller samples of individuals. It may not be perfect, but it certainly can serve as a guide.
Thanks, Andre. I know I'm a moderator here, not a panelist, but since we're in the bonus side, maybe you'll indulge me. We did I mentioned a recent study at CGAP looking at trends in outreach to women, and I think it's relevant to this question of how corporate governance matters. So we're looking for correlations in the MFR data between outreach and other indicators. We looked at percentage of women's staff. That didn't seem to be as highly correlated, but what was in this data was women in board positions. So that tended to be highly correlated. So this wasn't an RCT. So the direction of causality is uncertain, but I thought that was a really interesting finding. And in this question too of, the value of RCTs versus other methods, I do think that less rigorous methods often lead to asking the types of questions that can then be assessed more rigorously, and there's a very important role for non-RCT type of studies. Just my 2 cents on the topic there.
I agree, Alexander. But I do think probably this is the right time for us to wrap up. Thank you to everyone for all the comments. We are going to pay attention to those, and like I said, very clearly there's demand, so we will be working together to have more.
Yes, thank you, Tim. Thank you, Andre. Valdete, were you going to?
Yeah, I was just going to say thanks to the panelists and to everybody who still is sticking around. We will share the recording and we'll be in touch as well with other related material and follow up with Phi Live for another session. So thanks again, and we'll see you soon.
Take care, everyone.
Thank you, everyone.